Hello, everyone. Welcome back to another episode of the Week in Charts. Charlie Bilello here, bringing you once again the most important charts and themes I'm seeing today in markets and investing. If you're watching this on YouTube, quick reminder, hit that subscribe button for all the latest content from us. And if you're watching this looking for a second look on your portfolio or your financial plan, now's the perfect time to reach out to us at Creative Planning. Go to creativeplanning.com/Charlie and get a free wealth path analysis when you schedule a call or a meeting with an advisor. At Creative Planning, we're located in all 50 states, so we likely have a location right near you, over $390 billion in assets under management and advisement, and we're here to help, so reach out to us today, creativeplanning.com/Charlie. So much to talk about today. We're going to run through a lot here. 50-year mortgage, why I think that's a terrible idea, how to make inflation spike again. Nobody wants that, but I think if we did this policy that's being suggested, that's what would happen. This is the end of a historic uptrend today in the S&P 500. Michael Burry's back with a bearish bet on tech. We'll talk about that. December rate cut now in jeopardy. Market is not pricing in a cut anymore at the December meeting. Rising delinquencies. We got new data from the New York Fed talking about rising credit card delinquencies. All tariffs are transitory. That's been my saying this year, and we're seeing that once again. Latest developments in tariffs we'll discuss. The MicroStrategy moment. Is it the moment where the strategy that MicroStrategy has pursued is going to cause problems for the company and perhaps for the broader crypto industry? And we'll end with something positive, as we always do, and that would be driverless cars increase in terms of the usage there and the potential benefits for all Americans. Let's start out here. Why the 50-year mortgage is a terrible idea. First, I want to just give a backdrop. Why are we talking about a 50-year mortgage? Well, it's because this is the least affordable housing market in history. You can see home prices in the U.S. talking about existing family homes here. Single family homes up 172% from the lows in 2012. We're talking about an increase from 155,000 back in 2012 to over 420,000 today in terms of the price. And needless to say, people's incomes have not gone up 172% over this period of time. Zeroing in the last 10 years, 90% increase for U.S. home prices nationally, more than double the increase in hourly earnings in the U.S. And if we're looking at mortgage rates, you can see here it's not just the fact that prices have gone up, it's also the fact that mortgage rates have more than doubled from the lows back in 2021. So we're talking about 2.65% at the lows. Current rates are 6.24%. So you combine rising prices with rising mortgage rates, and that's a recipe for the least affordable housing market in history. Many ways to look at that, but the chart I'm showing you here, 57% affordability gap between the income you need to buy a home and people's actual income. So people's actual income is much lower than the income they would need to actually afford the home and qualify for a mortgage. And what that's been causing in the housing market is a delaying of the American dream. As I talked about last week, the average or median age here of the first-time U.S. home buyer has gone up and up and up, hit a record 40 this year. So 40 years old is now the median age of a first-time home buyer. That's up from 31 a decade ago. Why are people delaying the purchase of that home? Because they just simply can't afford it. So the latest development here in terms of how do we address this lack of affordability came from the White House, and they're talking about a 50-year mortgage being a, quote here, complete game changer. And so the question is, should we do a 50-year mortgage? Is this something that would actually help affordability? Is it a good idea? And before we attempt at answering that question, first we have to look at, well, what would be the difference in terms of payments? What would be the difference in terms of the amount of interest you're paying in a 50-year loan versus a 30-year loan? And I break it down over here. And what I'm assuming here is simply that median home price in the U.S., $420,000. And I'm assuming the 30-year mortgage, you're getting the rate that's available right now, 6.24%, assuming you have good credit. And I'm adding a half a percentage point to the 50-year mortgage, saying 6.74%, because a 50-year loan substantially higher would be the interest rate that you would have to pay. So I'm assuming 6.74% for 50 years, 6.24% for 30 years. And here's the difference in terms of interest payments here. 407,000 in interest on that 30-year mortgage. So it's more than you're paying in principal. You're paying in interest over that 30-year life of the loan. But if we look at the 50-year mortgage, you're talking about double the amount of interest. So over 800,000 is going to be paid in terms of interest. And looking at it on a percentage basis, 71% of your payments over the life of this 50-year mortgage will be interest payments and just 29% principal payments, substantially higher in terms of the interest than a 30-year mortgage, which would be 55%. And if we look at the first 10 years of each of these loans, you could see big difference is if you're looking at a 30-year mortgage, about 79% is going to be interest payments in the first 10 years, 21% going towards principal. So you're building equity at a faster rate, a much faster rate than the 50-year mortgage, where 95% of that monthly payment is going towards interest, 5% principal. So why would you consider doing this? Well, it's really just looking at the monthly payment. And they're saying the monthly payment right now is too high. And so if we extended the loan term, you're going to have a lower monthly payment. And here, that is true. You're saving a little over $100 a month in terms of that monthly payment. Is that enough to make it substantially more affordable? Not really, given how unaffordable things are. And then you have to think about the other problems that a 50-year mortgage is going to cause, namely the fact that if you're going to lower the monthly payment for people, it's going to increase demand. So you wanted housing prices to come down potentially, so become more affordable. And here you're going to increase demand, and that would, all else equal, drive up home prices. So it's not a market mechanism. It's a government-supported mechanism, so it's not something that would have come out about in the free market. No bank is going to lend at a 50-year rate, so presumably the government would have to backstop these loans, these 50-year loans, and that's creating artificial demand, which begs the question, why would we consider doing that, which is essentially why we got into this mess in the first place, was creating artificial demand. So if we look at what we did in terms of 2020, 2021 with the stimulus, 3 different rounds of stimulus payments, that drove up demand. You have the Fed cutting interest rates to 0% and buying all those mortgage bonds. That created artificial demand, driving up prices. And lastly, you have Fannie Mae and Freddie Mac just continuing to gain power over this period of time. Now 70% of mortgages are being guaranteed by Fannie and Freddie, so not a free market. So you're creating more demand, driving up the cost of housing for everyone, but you're going to lower that potential monthly payment by a little bit. I don't think it makes sense at all. Certainly not helping people, putting them in these 50-year products, paying all of that interest. You should be encouraging people to reduce their amount of debt and not take on a 50-year debt load just to have a little bit of an increase in terms of what they can buy from that monthly payment, which will likely be counteracted with the fact that prices are going to go up by that increase in demand. So for all these reasons, I think it's a terrible policy. If you want home prices to become more affordable, make it more of a free market. Stop printing money. Stop having the Fed cut interest rates down to 0. Stop them from buying mortgage bonds and artificially influencing the market there. And slowly widen down Fannie and Freddie and stop with the FHA guaranteed. So really, essentially the opposite of what they're attempting to do here is what would actually make housing more affordable. And we know this because this is what has made housing unaffordable, was all of these things that we're talking about helping people. Well, they actually hurt people because it drove up the rate of inflation and created artificial demand in the market. So we didn't learn anything if we're going to do a 50-year mortgage from the past few years. And most people, if they want housing to be more affordable, they shouldn't be in favor of that 50-year product. If you think it through, it makes absolutely no sense, in my opinion. Hopefully, this is not something that is passed and we don't see 50-year mortgages in the U.S. I don't think this would be a good thing for the housing market, and certainly wouldn't be a good thing for anybody who's taking on that level of debt. I mean, if you have a 40-year-old taking on a 50-year mortgage, now you're taking on a loan greater than your life expectancy. So instead of leaving money to your heirs, you could potentially be leaving them with debt that hasn't been paid off. Not a good thing for a million different reasons. And so hopefully we don't see a 50-year mortgage anytime soon. Let's talk about how to make inflation spike again, which is not the proposal here. They're actually saying, well, this is a good idea in response to the higher costs. So there's a big push now to do things to address a lack of affordability. I just talked about the 50-year mortgage, but people are complaining about grocery prices. They're complaining about insurance prices. Well, everything has seemed to go up and to the right and really higher than what the government is actually saying in terms of the actual CPI. People are feeling the cumulative increase over the past 5 years in terms of inflation. So ideas like this are very popular. This is the idea here, essentially take $2,000 and send it out to all Americans except high income people, they're saying here, but everyone else is going to get $2,000, and they're going to use the money that they've been getting from the tariffs. So the customs duties that we've been talking about, which is about 30 billion a month, they're going to take part of that, I guess, or maybe even all of it, and send it out to people in the form of this quote unquote dividend check. Now, what's the problem with this? Well, again, this is the goal of this is essentially to help people with affordability and help people because of higher inflation. And so no doubt this would be a popular program, but what would that actually do when you're running a nearly $2 trillion deficit and you take away some of that revenue that's coming in and say, we're just going to send it out to people? Well, that's of course going to spur inflation. So this is the deficit picture right now. It's close to 2 trillion. And if you did these types of payments, it's going to make that increase. And what that's going to do in terms of CPI is going to drive it up, just as it did in 2022. We saw the highest inflation rate in 40 years. Why did that happen? Because we borrowed money and sent it out to people, to businesses. 9.1% was the peak there. So the goal is to make things more palatable in terms of inflation, but if you send free money out to people, it's going to cause even more inflation. That should be obvious because we did that before. We saw the result of it. But in terms of ideas here, absolutely terrible idea. And you're essentially, if you think about the tariff, you're essentially taxing people and then giving them some of that money back. So the tariff, as we know, is going to be eventually passed on to the consumer. Maybe it hasn't been as of yet, although we are seeing inflation go up here, but eventually it's going to be passed on, at least in part, to that consumer. And now you're saying you're going to give part of that revenue back to them. How nice of you. But what it's going to do, if you're borrowing money already, is going to create more inflation. Not a good thing. So what should we be doing to help people with rising prices? Well, address those higher prices. So until inflation comes back to that 2% trend line, this is the Fed's target, 2%. We've more than doubled it since the beginning of 2020. Until it comes back to that trend line, well, stop doing this crazy deficit spending, stop cutting interest rates, and stop doing all of these things that promote higher inflation. That would be a much better policy than sending out $2,000 to everyone, which would feel good in the short run, but in the long run, it's not going to feel good when those prices rise. And we saw that back in 2022, and we'll see it again if this policy goes through. This is the end. This is the end of a historic uptrend in the S&P 500. You could see the smoothness of this. So since the end of April, the S&P 500 has closed above its 50-day moving average every single day. And we haven't seen even a 5% pullback during that period of time. And today, just today, we closed below that 50-day moving average, first time since April 30th. One of the longest uptrends in history, actually fifth longest since the 1950 here for the S&P 500. And you can see 1995, 1996 being the longest, 371 days. But here, almost 200 days of a smooth ride higher with no real pullbacks along the way, which is highly unusual, of course, since it's the fifth longest in history. You could see some of the other dates here, 1958, 1960, 61, and 2006, 2007 was the last time we saw an uptrend this long in the S&P 500. So just looking at these dates, what has happened after the uptrend has ended? Of course, that's going to be the question here. And I don't see anything really meaningful in terms of the data here. I don't see anything suggesting that the market has to go down a lot here over the next few months or the next year. It's essentially mixed results. We have some down 1 year returns for the S&P 500. We have more up than down. And on average, the market tends to be higher over the next few years. But what I would say is this idea that you're going to just have a pullback here and then go back to this enormously long uptrend, probably not likely. And in terms of volatility, we've talked about the last 6-7 months. Very unusual to see this low level of volatility, which with this huge advance. So we're talking about a 20% gain since the S&P 500 has been above its 50-day moving average without so much as a 5% pullback. And we saw the market off of the lows in April gain over 40% without a 5% pullback, which is really, really remarkable. So very unusual. And in the past few weeks, we've seen a few bigger declines. We've seen a few greater than 1% down days for the S&P 500. But this year, very, very typical. 26 of these so far this year. The average year since 1928 has 29 of them. And really, most of this, of course, was concentrated in that period in March and April when the market was going down, when we had a bear market for the S&P 500, with the S&P 500 down over 20%. And the last 7 months, very few of these, but just seeing more in the last few weeks, a little bit more volatility, but perfectly normal. If we look back at history, it's been a very mild last 7 months. So to suggest that this is something out of the ordinary, very much not the case to see 1% down days. That's more normal than what we saw over the last 7 months, which is really one of the most historic uptrends in history. And in terms of corrections here, we've only had one so far this year. We had that 21% decline from February peak to the April lows, and then it's really been smooth sailing. And that's pretty rare in terms of the S&P 500. Most years have a few of these 5+% pullbacks. Are we in the midst of another one? We won't know, but it shouldn't be a surprise. We won't know until after the next few days, over the next week. But it wouldn't be a surprise if we had another correction here, given what the sentiment was, as I talked about last week. We had active managers levered long. We have the fewest number of bears and various sentiment polls that we've seen in years, and both of those extremes were followed by corrections in the S&P 500. So perhaps transitioning to a more normal environment here in terms of the 50-day, but really no signal in terms of looking in the past saying it could continue to go higher after the market breaks below the 50-day. It could recover, or it could continue down. We've seen both of those examples in history. Burry's bearish bet, Michael Burry, back, and he's talking about tech here. Everyone knows that most of the time when he's talking, it's bearish bets. A few years ago, he just came out with that one-liner on Twitter at the time where he just said sell. And of course, the market's up substantially since then. I think that was in the beginning of 2023. We had a huge advance that year, and another huge advance in 2024, and of course up this year as well. But his latest is in terms of artificial intelligence here, he has an issue with the way they're calculating earnings, and he's saying that they're underestimating depreciation. So essentially, all of the CapEx that we've been talking about in terms of increasing CapEx from the big tech players, he's saying, well, the life of those data centers and all of that investment is going to be less than what they're actually assuming. So if they're assuming 5-6 years for that stuff and they're depreciating over that period of time, when really the life is 2 to 3 years, that's artificially boosting earnings because they're not taking as much off of their sales in terms of that depreciation charge. And he's saying it should be bigger because it should be over a shorter number of years. And he's saying that is going to understate depreciation by 176 billion. So not a small amount across the industry. And he talked about some of the names here. And in the filings, the 13F filings, he revealed that he has put positions, so bearish bets against Palantir. I think that was the biggest one, and NVIDIA. And so if you look at all of this, we put it together, is some of the arguments that he's making, does it make sense? We don't know until we actually see these things over the next few years. I've certainly made the argument that their potential risk in terms of spending all of this money is that these things become obsolete much quicker than they imagine, and they'll have to either re-up that bet at that point in time, or they'll have to make a decision, well, maybe we'll pull back in spending. But it's not clear yet that they're going to get the return that they're that they're going to get in the next few years out of all of these investments. So certainly a valid concern. I think in terms of should they be depreciating them faster, we won't know until after the fact. But I think if you ask Burry, well, what is the real bigger concern in terms of some of his bearish bets? It's that expectations are so high. And the biggest bearish bet he has is with Palantir. I've talked about the valuation there. And obviously, people are expecting big things from Palantir over the next few years. But the question is, are expectations way too high? And the only way to evaluate that is to simply look at its valuation multiples. And I really haven't seen anything like this for a company this big. We're talking about over $400 billion in terms of the market cap. And you're talking about a price to sales ratio of 114x and a forward price to sales ratio of 67x. So high expectations. If we look at earnings, similar story here. P ratio over 400 and forward P ratio 176. So really the question is the quality of the earnings for the S&P 500. If we're talking about they should be depreciating things faster, they're inflating their earnings, well, then that might call into question some of the really strong earnings we've seen this quarter. 23% earnings growth year over year this quarter, a big number, far ahead of expectations, highest we've seen since 2021. And this is the really striking thing. We're seeing margins this quarter. We don't have all the companies, so this isn't a final number yet, but potentially hitting a record high in terms of profit margins, 13.8% for the S&P 500. If that holds, that would surpass the prior peak from 2021. And if we look at overall trailing 12-month operating earnings for the S&P 500, on pace to hit another record high, up 13% year over year. So if he's correct and these earnings are being inflated to the upside, well, then that would call into question some of this growth, definitely call into question that record high in terms of profit margins. Let's talk about December rate cut here. It's in jeopardy. It seemed pretty high probability a few weeks ago, much lower probability today, but I wouldn't say that it's not going to happen just yet. We just have to wait until we get more data here. 40% chance now of a rate cut and 60% chance the Fed does nothing. These are going to change wildly over the next few weeks until that December 10th meeting. And really why it's come down is just comments out of people from the Fed. They do these speeches, and you're seeing more people call into question here. You got Susan Collins, Boston Fed president, saying she thinks it's appropriate to keep policy rates at current levels for some time to balance the inflation employment risks. And she's saying it's a high bar for additional easing in the near term. And there's the opposite end is are those that are saying that the Fed isn't being aggressive enough. So like Mirren, who's been dissenting, saying that the Fed should be cutting 50 basis points. So you have that camp on the opposite end. But a growing number here kind of questioning, should the Fed keep easing here despite rising inflation and despite the fact that we're really been in a somewhat of a data vacuum because of the government shutdown. And what we're talking about is a lack of employment data and a lack of inflation data. Some of the employment data is set to come out this week. We're looking at the September number, which should have come out last month. And what they're expecting here is 50,000 in terms of non-farm payrolls. But I think they said that they're not going to release the unemployment rate because that's based on survey and they don't have enough survey data there. So it's still going to be a lack of data, but we'll get a little bit more clarity with that report. And then in terms of CPI, that didn't come out last week. It was supposed to come out in the middle of last week. Didn't come out. The estimate from economists was 3.1%. So that would have been a rise in inflation if that number came in at the consensus. So needless to say, more difficult to make a decision in terms of the Fed. We already know inflation's at a 16-month high, and potentially it would be even higher had we got this data point. But we also know the labor market's been slowing. And so let's say we get a negative jobs number this week for that September number. That would probably push the Fed back to cutting rates in terms of the market's expectations. So we'll see how much of the government data that wasn't released during the shutdown, how much is released. in the next few weeks, and will it be enough to push the Fed back to doing one more rate cut this year? That'll be the question. Let's talk about rising delinquencies here. We're talking about the New York Fed. They do this household consumer debt analysis every quarter, and they just released the latest here. It showed another rise in credit card debt delinquency. So 90 plus days delinquent here. 12.4% of balances are now in that 90 plus day delinquent camp. That's the highest we've seen since 2011. You can see student loan debt, the spike here with the resumption of credit agencies starting to report that. There was a big lag, of course, after there was a delay during the pandemic where people didn't have to pay back the loans and it wasn't being reported on credit agencies, and now it's being reported again. You're also seeing auto loans ticking up as well in terms of delinquencies. We're at 5%, and that's likely to continue rising. You can see here subprime borrowers are particularly stretched here in terms of auto loans. 6.65% are 60 days past due. That's a record high, higher than we saw during the financial crisis, higher than we saw back in the 90s when we had a spike in this ratio. So something to watch here as well is the auto delinquency data. But basically, as I've been talking about in terms of the credit card, there's those who are carrying a balance and then there's those who aren't. And so this is really widening the gap in terms of spending between lower income consumers and upper income consumers, or upper income consumers are making up more and more of a share in recent months in terms of spending, and lower income consumers seem to be being hit harder by rising inflation rates. And now you have this additional factor where they seem to be getting stretched in terms of delinquencies, having a harder time paying back credit cards, student loans, auto loans, etc. So something to watch when we get that retail sales data, which was also delayed by the government shutdown. All tariffs are transitory. I've been saying this the entire year. I think that's a big reason why the markets have largely ignored it since that April bear market that we saw back then. It's essentially because everything that we see in terms of tariffs, it seems to have a very short life, and then we see something completely reversed. And every week there's something new where there's an about face. And last week we saw President Trump moving to lower tariff duties on beef, coffee, and dozens of other goods as people are becoming concerns of cost of living increases there. So they're lowering the cost of those tariffs, likely to lower the price of those end goods, which is an admission, of course, that it was pushing up the prices of some of those goods for sure, which is what they said wasn't going to happen. But obviously, if they're reversing that because of cost of living concerns, then there is an admission there to say that it was pushing up the price of some of these goods. And then with Switzerland, we've seen this a number of times with various different countries. They had a very high tariff rate for some reason, 39%, and that was reduced to 15% after a number of Swiss executives actually came to the White House, met with President Trump. And we've seen this story many times. They promised a big investment into the U.S., $200 billion. We've seen a lot of these promises. I don't know how they're going to make good on all of these promises, all these different countries, but at least that seems to be the way that they're able to reduce this tariff rate. And I think there was a headline saying the Swiss economy had a negative GDP print the last quarter because of these higher tariffs. So clearly incentivized to try to negotiate to bring this down, and they were successful. So looking at the overall tariff picture here, 17.9% is the rate here. You can see the huge spike. But again, this was much higher. This was well over 20% at the start, and we're just seeing one country after another renegotiate these things, more exceptions to all different goods. So where will this settle at? Nobody knows. And then we have the whole Supreme Court thing that's going on where they're reviewing the power of the president to enact all of these powers, and it seems likely that at least some of them are going to be ruled invalidated just by the questions that they're asking so far. Does the president have the power to universally raise the tariffs on all these different goods, all these different countries, under the International Emergency Economic Powers Act. There's a lot of people arguing, saying, no, that's not the case because a trade deficit doesn't really constitute an emergency. It's not really what that act was for. So if they invalidate a lot of these tariffs, then of course this rate comes down. You're going to have to refund, of course, a lot of different people that have paid the tariffs in the first place. It's going to be a complete mess. But the overall point is all of this tariff stuff is a moving process. It's all transitory. We don't know where it will actually end up. And the minute they see that it's causing some type of harm, whether it's economics or cost of living, I think they'll reverse the policies. We saw that with all of the food items that they became concerned about and changing the policy there. So we'll see how the Supreme Court rules here. I think it's likely that at least some of them will be ruled unconstitutional, but we'll see how much of an impact that will have, because they could always say, well, okay, we're not going to use this act, we're going to use another act. So this is going to be obviously a drawn out process. But I think the overall point is, don't believe the scary headlines that come out first in terms of tariffs, because very quickly it seems to change in the opposite direction. And we've seen that all year long, and we're likely to continue seeing it over the next year. So let's talk about Bitcoin and MicroStrategy. Is it the moment that MicroStrategy is going to be tested in terms of, it's a Bitcoin treasury company, it issues debt, convertible debt, to buy Bitcoin, and is this the moment where it's going to be tested in terms of Bitcoin having its decline? First, let's define what this Minsky moment concept is. This was coined by Paul McCulley, named after a famous American economist, Hyman Minsky, and he had this financial instability hypothesis, which essentially argued that periods of calm, periods of ease, periods of growth in the economy eventually leads investors, financial institutions to take more and more and more risk. And then they see that things are just going up. There's low levels of volatility. And so naturally they become more and more speculative. And eventually they say, well, if there's really no risk, I should just be applying leverage to get more and more return. And this creates vulnerability to a crisis, of course, if you have a levered asset that can potentially go down in price. When that price decline occurs, you could have really a negative feedback loop, and you could have forced sellers where the price is going down, you have a margin call, you have debt coming due that's on that asset class, and you have to sell it in order to meet that payment. So that's the fear in terms of the crypto market today, and particularly MicroStrategy, which has been issuing debt over the past few years to buy their Bitcoin securities. And when Bitcoin's going up, it's a wonderful strategy. It seems to be working very well. When Bitcoin goes down, then it's really called into question. And over the past month and a half, we've seen a decline in Bitcoin, not a big one, I would say, whatsoever, but it's really moved Bitcoin from being one of the best performing assets this year, up 35% in early October. It was number 2 after gold. And now it is the worst performing asset class, and actually went slightly negative on the year in the last 24 hours here. So after 100+% returns in 2023 and 2024, we have it now down slightly on the year, but only down 25% from its peak in early October. I say only because to be a major correction for Bitcoin, in my opinion, you got to be at least 30% in terms of the downside. We saw that in earlier this year from January to April, where we saw a 32% decline, and it would take a few thousand more to get there. Now currently down 25% from its peak in early October. And we're talking about MicroStrategy here. What I said a year ago, this is really a sign of speculative behavior in the crypto market. We were seeing many different signs of it after the election, just people rushing into crypto, anything that they could find. And really, MicroStrategy became the poster child of this. And the investors bid the shares up to over 3 times the value of the underlying Bitcoin, which was really an unsustainable situation. But people were making arguments for why it could continue, why it could persist. And none of it made sense to me. It was just really evidence of a mania. And today we see the other side of that mania, which is now strategy trades at its Bitcoin holdings, essentially par with those underlying holdings. And so if you bought strategy a year ago thinking you were buying Bitcoin, you were going to go, strategy would go up. If Bitcoin went up, well, that hasn't been the case. Bitcoin's higher than where it was a year ago. You got strategy down 39%. And if you bought the levered ETF, not a good idea on a volatile asset like this. 2x long is down 87% over the past year. So as Peter Lynch once said, know what you own and why you own it. And buying this thing a year ago at 3x its underlying Bitcoin holdings wasn't buying exposure to Bitcoin. But the question in terms of the Minsky moment or the MicroStrategy moment, as I'm calling it here, is will there be a point in the future that MicroStrategy's strategy of using debt to buy Bitcoin, will that cause them to be a forced seller? And that only will happen if the price of Bitcoin has a huge decline and it stays down, and it's down during the period where these convertible debt securities come due. And so the holders decide, I'm not going to convert to equity. I want my money back. And at that point, because Bitcoin is down so much, MicroStrategy can't issue new debt. They can't issue new equity. And so they have to sell their existing Bitcoin to pay back these debt holders. That is the question. Will that happen at some point in the future? And certainly you would have to say there's a risk of that happening. Obviously, strategy is not assuming that's going to happen, or they wouldn't be pursuing this strategy, but there is a risk of that happening. And if it does happen, is the leverage in the system enough to cause the wider crypto infrastructure problems there? And because of the financialization of Bitcoin in recent years, is it going to lead to other problems in the financial industry as well? Again, these are all questions, I think valid questions that people should be asking. And we don't have the answers to them because we don't know what's going to happen in the future. But it's given the declines of Bitcoins in the past, it certainly wouldn't be super unexpected to see another 50, 60, 70% decline in this asset. And when that happens, that, of course, is going to be the test for strategy. How are shareholders going to react? And more importantly, how are these convertible debt holders going to react at that point in time? So I want to end with something positive, as we always do, and that would be driverless cars. We know the cost of transportation, huge issue in the U.S., just seeing rising prices in terms of what it costs to buy a vehicle, now above $50,000 for the first time in terms of the U.S. Just a decade ago, we were under $35,000 in terms of the average price. So significant increase. And partly because of this rise, we're seeing more stress on borrowers whose monthly payments have gone up and they simply can't afford those payments anymore. And when the price of an asset goes up, it costs more to insure it. And at the same time, it's costing more in terms of the parts. It's costing more in terms of the labor to maintain it. So all of these reasons have led to a really auto insurance rates to skyrocket over the last decade, 94% increase. And that's significantly higher than the overall rate of increase in terms of consumer prices, 35%. So one thing that could potentially help with that is more driverless cars. We're looking at Waymo here. Just hit 1 million rides per month for the first time. This is just in California. Huge increase that we've seen over the past few years. You can see what they were doing in terms of, it was just in the thousands back in May 2024. You're below 100,000, just crossed above it in May 2024, and now you're at 1 million per month in terms of these rides. So really just scratching the surface here. And the goal, I think, of this is to have people not be forced to own a car that they're not using every day. So if you use a car every day, probably makes sense for you to own it or lease it or have it available every day. But if you're only using it once a week or once a month, maybe we're going to have a future where these driverless cars are readily available, and it would be cheaper for you to just use one of them when you need it versus having the cost of owning it, maintaining it, insuring it, all the rest of it. And an additional benefit, and this is the huge one that I think about all the time, is how do we reduce accident rates in terms of human error? And accident rates have been trending up for many different reasons. but certainly not something that you want to see. And certainly it doesn't appear to be the case that humans are going to become better drivers anytime soon. And these driverless cars seem to be getting better and better in terms of their technology, in terms of their safety. And this is data that we have here in terms of, do they reduce crashes? Do they reduce pedestrian accidents or accidents with cyclists, motorcycle accidents? You can see across the board, huge reductions. And that should lead to, in the long run, if we see more prevalence of this, obviously lower costs in terms of insurance and more people adopting this. So if it's safer for you or for your kids or for your parents or for your spouse to be driving in one of these versus driving themselves, then I think more people are going to adopt these things. So I think that's where we're headed, and it's probably going to continue on this exponential curve for all of the reasons here that we're talking about. It's cheaper, it's more efficient, and it's potentially safer as well. So that's a very good thing. And I think we're not far off from this being something that's more widely adopted than just seeing it in certain cities around America. I think we're going to see just the prevalence of this continuing to increase in the coming years. Okay, we'll end it right there. Thank you for everyone for joining me on the Week in Charts. Have a great week. If you're watching this on YouTube, hit that subscribe button. I'll see you next time on the Week in Charts.